Hello everybody, welcome to another episode of Erickson TV, courtesy of Lauren. Hey Lauren.
Hey everybody.
Hey Lauren, we're going to continue on with our summer back to school series.
That's right.
This was a great one that you thought of, which is because it's a question that I think clients or people that are just learning about investing have in the back of their head, but they don't know maybe how to phrase it correctly.
Right.
But it's something about the uncertainty of the future,
yes.
and how to invest with all the uncertainty in the future.
Right,
so,
right.
what was the research that you found there?
Yeah. So what happened was this was a question that was asked for me on the Boglehead forum, and this is going to be a little bit different than most of our episodes because I'm not going to just sort of be speaking off the cuff.
Right.
Because somebody asked a question, I really liked the particular way that I answered it, and I think that the answer is particularly effective. What the person was saying is they were responding to the sort of thing that I say all the time, which is that experts can't predict the future, we can't predict the future, all these prognostications are really not very useful.
In fact, we just talked about that with regard to
right.
the debt ceiling issue.
Yeah, exactly. We don't know what's going to happen. Maybe it'll cause problems, maybe it won't cause problems. You really don't know. So the question was this. The guy says, okay, look, if we can't predict the future, then why are we investing in the stock market to begin with? What's to prevent the global stock market from having negative returns over the course of the next 20, 30, or 50 years? What are we basing expected stock returns, no matter how low, if not on data of the past returns? And since data on past returns might not have any value, then he goes ... So basically it's a question of we can't really be certain of what's going to happen, and our predictions don't seem to work, so what are we doing? Why are we doing this? Okay, so here was my response. I told him, at first I said, well, you've already gotten some good answers, but even though the answers were good, and even though they're correct, they were not very concrete. So here is my concrete example. I expect to live another 40 years. I invest and I plan based on that expectation. I might die tomorrow. But the chance is small. Still, if I had kids, I would buy life insurance to protect them from the risk that I might live a much shorter life than I expect. Okay. I expect stocks to have positive returns over the next 40 years. I invest and plan based on that expectation. Now, a global portfolio of stocks might have negative returns for 4 decades, but the chance is very small. In the case of stocks, I don't combine some bonds and cash with stocks as insurance in the way someone might buy life insurance. The issue is more that stocks go down at the worst possible times. The times when I'm most likely either to be unable to contribute to my portfolio, or worse, the times when I'm most likely to actually have to take money out early because of something unexpected.
Right.
Those are exactly the times when the stocks are most likely to go down. And everyone investing in stocks faces that same risk. Everyone. Even institutions that have an infinite time horizon might need the money they have invested sooner than they think. And if they do, they're more likely to need it at precisely the time when markets go down. Since stocks are risky for everybody, no matter what their time frame is, no one would be crazy enough to invest in them unless they expected a higher return. So the fact that stocks have a positive expected return is not based on looking at the past.
Right.
The fact that I expect...
Because of that uncertainty.
Yes, exactly.
Right.
It is precisely because of the uncertainty. So I expect to live another 40 years. That's not based on the fact that I've lived 35 so far.
Right.
I expect stocks to go up for 40 years, the next 40 years. That's not based on what they've done in the past.
Right.
It's based on rational assumptions about the future. Now, if you ask me, about how high is the expected return, that's where I defer to the past.
Right.
And I say, whenever I'm looking at any stock asset class, I look at as much data as I can possibly find to avoid cherry picking, because you don't want to just cherry pick. And I just say, look, I think that that's the best possible guess at what it's going to be.
Right.
But it's a guess. We don't know for sure. But if you're asking, the fundamental question, why do we invest in stocks even though we don't know what the future holds? The odd answer to the question is, we invest in stocks because we don't know what the future holds.
Right.
That's where the higher expected returns come from. It's precisely from that uncertainty.
So as part of our back to school learning, if you invest all your money in very conservative short-term, let's say guaranteed CDs or money market accounts, there is no uncertainty. You know that you're going to get back your principal because it's insured. But also because there's no uncertainty, there's no returns above inflation.
Yeah, exactly. That's precisely how it is. And in fact, right now, because people's desire to eliminate uncertainty is at such a premium, right now you actually have guaranteed negative real returns. if you invest in all of your money in very conservative assets.
Okay. So then to bring this all back to moving ahead, people I think intuitively know that they have to grow their portfolio
Yep.
to be able to have a dignified and independent retirement. And then number two, we're embracing that uncertainty,
Right.
To capture those positive expected returns, even though there's no guarantee that they're going to get those positive expected
Yep,
returns.
that's
Okay.
exactly right.
Okay, great. Well, thank you, Lauren. That was a very different way of answering a question that I don't think most people phrase correctly.
Right,
Yeah.
and it's a tough question because what most people have been told their whole lives about investing is that the reason you invest in such and such a way is because it worked in the past.
Correct.
No, that's exactly like saying that I expect to live 5 more years because I lived 35 so far. It doesn't make any sense. That's not the reality of the situation. And the reality of the situation is that, yes, we embrace uncertainty.
Right. And then I know I don't want to dwell on this point, but in the short term right now, we're seeing lots of different uncertainty
Oh,
type
yes.
events. And
That's right.
in a perverse way, that short term uncertainty, that volatility will actually likely increase our positive expected
That's right.
return down the road. So
That's
so
exactly correct.
So in a perverse way, we should be embracing it.
Yep, we have to.
Okay. Well, thank you, Lauren, very much. Appreciate it, and have a great day. We'll see you
Yeah.
next time on
See you next
EricksonTV.
time.
Bye now.